The Bank of International Settlements says there is $80 trillion worth of debt in FX swaps, and in their words, the problem is huge, missing, and growing. What's up, guys? I'm Nobody Special, and with that, we are going to shrink my big melon of a head and take a look at this report today from the Bank of International Settlements. It just came out this morning. Dollar debt in FX swaps and forwards, huge, missing, and growing. Embedded in the foreign exchange market is huge, unseen dollar borrowing in an FX swap. For instance, a Dutch pension fund or a Japanese insurer borrows dollars and lends euro or yen in the spot leg and later repays the dollars or receives euros or yens in the forward leg. Thus, an FX swap, along with its close cousin, a currency swap, resembles a repurchase agreement or a repo with a currency rather than a security as collateral. But unlike repo, the payment obligations from these instruments are recorded off balance sheet in a blind spot. The 80 trillion plus in outstanding obligations to pay US dollars in FX swaps, forwards, and currency swaps, mostly very short term, exceeds the stocks of dollar treasury bills, repos, and commercial paper combined. The churn of deals approached $5 trillion per day in April of 2022, two-thirds of daily global FX turnover. So in other words, there is 80 trillion, that is 80 trillion with a T, worth of debt in this FX swap market, and it's basically more than all the money in the world. Now look, folks, I realize it's the 2020s and a trillion with a T doesn't really carry the weight that it used to, but it's really important to get your head around this, folks, because our minds are not really built to understand and to deal with numbers in this scale. If you were to take this US dollar bill, for example, right here, all right, the average US dollar bill has a thickness of about 0.0043 inches. Now, to give you an idea of just how much $80 trillion is, if I were to stack 80 trillion of these US dollar bills on the surface of the earth, the stack of bills would be enough to reach all the way to the surface of the moon and back 11 times. So hopefully by now you're kind of taking the walk with me and you realize, holy crap, this is a huge pile of debt. All right, the national debt is 30 trillion. We're talking more than double the amount of the national debt. This is a huge amount of money. Now, here's some of the charts that were included in the BIS report. Take a look at this first chart on the left. This is showing that almost all of this debt is denominated on one side of the swap in US dollars. People aren't trading francs for euros or yen for yuan or real for lira. People are trading almost exclusively for USD. All right, that's important. The US dollar is the world's global reserve currency, and so everybody needs and wants dollars. Now, secondly, I want to point your attention to this chart on the right, chart C, and that shows the counterparties to a lot of these swaps. And it's not just U.S. banks, it's not just non-U.S. banks, it's all kinds of financial institutions all over the world. We've got reporting dealers in yellow here, we've got other financial institutions, and we've even got non-financial customers like hedge funds, pension funds. So this money is owed all over the place. This is not just a bank problem. This is an entire financial system problem. But the big thing that I want to point out here on this 80 trillion plus in FX swaps debt is I want to point out the maturity, this center chart here, chart B. And this is the one that really illustrates just how big of a problem this could be and how quickly this could spiral out of control. Of all of this debt, look at here in pink, almost all of it matures within 1 year. Only a small fraction in this upper band here is from 1 to 5 years, and a tiny amount that barely even registers matures in more than 5 years. Almost all of this is ultra short-term debt. And that's why I want to point out this paragraph that's found on the top of page 3 of this report. The very short maturity of the typical FX swap or forward creates potential for liquidity squeezes. Almost 4/5 of outstanding amounts at the end of June of 2022, in graph 1B, the one we were just looking at, matured in less than 1 year. Data from April of 2022's triennial survey shows not only that instruments maturing within a week accounted for some 70% of FX swaps turnover, but also that those maturing overnight accounted for more than 30%. So this is very short-term debt, and it's constantly being rolled over for new debt. So it's not like this bill is all coming due and it's going to be paid back and we're done. This is an ongoing thing. Every day, new FX swaps are paid back and taken out. Trillions of dollars every day. And this is the operative phrase here. When dollar lenders step back from the FX swap market, the squeeze follows immediately. So by the time we realize this is happening, it will already have happened. And what this is in this case is a massive blowout in borrowing costs, a big spike in interest rates. So what the BIS is talking about here is if for any reason lenders in the FX swap market were to suddenly get spooked and start playing defense and be more hesitant to make these US dollar loans, these FX swaps, and it could cause real problems. Any reason, say the collapse of Credit Suisse or maybe ongoing contagion from crypto spilling over into the traditional finance system, something we could realistically see in the next few weeks or months. If these lenders were to pull back their lending, it would create an instantaneous short squeeze for US dollars, as borrowers all over the world who are looking to roll over trillions of dollars of immediately maturing FX swaps can no longer take out new swaps. They can no longer get their hands on dollars. So what happens when you have a massive demand and a sudden shortage of supply? You get big price spikes. And the price of money is interest rates. And that's very similar to what we saw in the repo markets in September of 2019 when overnight borrowing costs went from around 2% and suddenly spiked all the way up to 10%. It wreaked havoc in financial markets, and the Federal Reserve was forced to very quickly start printing money in order to shore up liquidity in these overnight borrowing markets. The only problem is this FX market is orders of magnitude bigger than the repo market. We're talking $80 trillion, most of which is maturing within a year, and a large portion of that maturing overnight on a daily basis. Trillions of dollars every day. Now, that's also a problem because if that happens, if we do create a shortage of dollars and nobody's willing to loan them, well, then people are going to have to get their hands on dollars any way they can. And what's the best way to get your hands on dollars? That's to sell something like stocks, like bonds, like gold, like Bitcoin, like real estate. Anything and everything you can get your hands on to sell in order to get some of those dollars that you desperately need. So if a dollar squeeze were to play out in the FX swap market, it could cause an instantaneous sell-off in virtually every asset across the board as institutions all over the world attempt to raise the trillions of dollars needed to keep these markets liquid on a daily basis. Remember, the dollar is the denominator in the asset price equation, and when the denominator gets bigger, the value of the fraction gets smaller. So this could actually cause a very rapid drawdown in asset prices across the board. Now, if you're sitting there scratching your head saying, I have no idea what he's talking about, I don't know anything about FX swaps or the FX swap market, that's okay, because if you focus in on this paragraph from page 2 of the report, it turns out neither do they. This off-balance sheet dollar debt poses particular policy challenges because standard debt statistics miss it. This is off-balance sheet debt. Banks are not required to report this stuff. Neither are hedge funds. Neither is your pension fund. Nobody's required to report how much of these dollar swaps they hold, even though technically they owe dollars. They might be holding euros, but they owe dollars, or they could be holding dollars and they owe euros. It's off-balance sheet debt. They don't have to report it. The lack of direct information makes it harder for policymakers to anticipate the scale and geography of dollar rollover needs. So in other words, they have no idea who owes it, where they are, and how much. Thus, in times of crisis, policies to restore the smooth flow of short-term dollars in the financial system, e.g. central bank swap lines, are set in a fog. So they don't know what the heck they're doing. They don't know how big the problem is. They don't know where the problem is. And when the problem finally flares up, they're just going to throw stuff against the wall and see what sticks. They have no idea what they're doing. So if you're sitting there feeling like, I don't quite understand what Jack is talking about here, don't worry, folks. Nobody knows. Isn't that great? One more thing I want to point out, folks, is we are just a few days after a major technical breakdown in the strength of the U.S. dollar as measured in the DXY or the DXY. That is the strength of the U.S. dollar against other global currencies. It was just a few days ago that the DXY broke down below its 200-day moving average, shown here in blue, and broke down below this red line here, which marks its previous low from back in August. Now, this was a pretty major technical event and had a lot of people saying the dollar milkshake theory is dead. A lot of people were taking cheap shots at Brent Johnson on Twitter. An event like a squeeze on the U.S. dollar in the FX swap market could send the DXY absolutely skyrocketing above 150, heading towards 200. It would cause a financial riot as people fought over the few dollars that were available that are out there by selling anything and everything, causing the dollar-denominated price of assets to collapse. So it's important to keep in mind that even though this chart would suggest that the US dollar is heading sharply lower in the near term, this situation in the FX swap market can't be ignored. So long story short, folks, there's $80 trillion worth of US dollar denominated debt in the FX swap market. That is more dollars owed than all the money in the world. It's all short term. This debt is constantly being rolled over, and the system works as long as everybody is willing to lend within that market. The second those lenders get nervous and stop lending, everything grinds to a halt, and it's anybody's guess what happens after that. Most people don't understand the problem. Most analysts don't understand the problem. Most bankers don't understand the problem. And it appears most regulators don't understand the problem either. Until next time, live small and dream big.